The other thing that's interesting, I just had another thought talking about the energy cost of mining. The energy cost of food is incredibly high. I mean, back in the 30s, typically food cost very little energy to produce. It was produced on the farm. They rotated crops, and it probably went by horse and cart very often to market, and so on and so forth. Yeah. I think the most recent calculations I saw was that lamb, in terms of energy, the energy output from lamb is 54 times the energy input to produce it, and the energy input being, mainly oil, effectively, because you've got mechanization on farms, you've got mechanized production of fertilizers and all the rest of it. I think so. Lamb was 54, beef was 50. I mean, even the humble vegetable now gets flown in from Africa.
Right.
I mean, it's so we've got this problem that energy has become central to so many other costs. And I think I'm right in saying that in America, the government regards this as non-core to the CPI because it's too volatile or something.
Right, and
it's an extraordinary situation.
It's been extraordinarily volatile to the upside.
Yes, exactly, one way. It's quite convenient for them, they say no.
Yes, the continuous commodity index, how long do we need? We'll go back 10 years. So continuous commodity index has a nice weighting, food, softs, grains, things like that. It's up an average of over 13% per year for 10 years.
My goodness.
And that's excluded from our core analysis of what inflation is. But you're absolutely right. Energy is embodied in a very non-transparent way in so many aspects of our lives. So you might not be aware that when you pull that head of lettuce out of the supermarket aisle and you take it home and it's got 100 calories in it, that there might be 1,000 calories of oil baked into that or more.
Yes, yes.
And so that's hidden in there. And so as energy goes up in price, you can just count on the embodied energy component to go up as well. And so the tightest linkage in all of the data series I've ever seen is between the price of food and the price of oil. And the reason is that we use it to plow, to fertilize, to harvest, to transport, to package, to refrigerate, or store in other ways. So there's so much energy embodied in our food system that, again, if we come into a situation where we're not talking about just sort of market shortages, which we'll experience as higher prices, but maybe actually structural shortages where we have to now ration. And we'll use the market to ration, right? So if we say, petrol is now $20 a gallon or, $10 a liter, however we want to measure it, 10 pounds a liter, we would say, okay, maybe we won't use that for these purposes. We'll use it for these. But we might have to find ourselves actually at a higher level making structural decisions, which are you don't want your farms having to make the economic decision whether to plant this year or not based on whether they think they can afford it. That's a recipe for disaster right there. So we might have to get into some more aggressive rationing at some point.
Right. So I think what you have described is a situation which really could lead to, even on government figures, a substantial acceleration in the rate of inflation in the early years of next year, in the early months of next year. If that is right, how can the Fed keep interest rates at 0% until the middle of 2013?
Well, mispricing of money is one of the quintessential sins of any central bank. The United States has been at the center of that story since Greenspan. He's somebody I've been a critic of for a long time, and I'm a similar critic of Bernanke at this stage. Mispricing of money, which I do believe should be left to the market pricing of money, is the one thing that's guaranteed to distort everything, right? So right now we have money apparently costs zero. And this is in a world where we have obvious risks, geopolitical risks, we've got solvency risks, we've got counterparty risks, we've got inflationary risks now. We actually have structural potential resource risks. We've got all these things baked in. Those should be priced in somehow, and they're not. So what you get is you get a misallocation of capital. One of the things that I was really shocked by was after the 2008 crisis, we had Lehman Brothers go down. They figured out that Lehman was holding, I think, 600,000 derivative contracts. 200,000 or 300,000 are still outstanding. They don't know how to unwind them. And they watched all these collateralized mortgage obligations and credit default swaps just blow up. And so you would think, logically, that what you would do in a circumstance like that is start to unwind that whole system. But if you peer into the system today, you'll discover there are actually more credit default swaps in the system today than there used to be. So we've learned nothing from that. But that's what you get when you put money at zero. You get speculation. If I'm near the central bank and I have access to 0% money and I get it, what am I going to do? I'm going to lever that up and I'm going to put that to as much work as I can, because bankers know one thing: you make hay when the sun shines, and 0% money doesn't last forever. So they're out there doing what they do.
Go and grab it while you can.
Absolutely predictable
Yes.
and expected, and not surprising, although maybe disappointing.
You would think in this environment that gold and silver would be more popular than they are, but I think I'm right in saying that the portfolio exposure to gold and silver is less than 1% probably still. And that is after very, very substantial rises in both gold and silver. But there's no move in that direction as far as I can see, and portfolio managers still seem to think, well, this is a bubble or something. I mean, is this your experience, that the portfolio managers are just really so far behind the curve in this? They've got a lot of catching up to do.
Oh, in the U.S., absolutely, that's true. Other parts of the world, I note that there's a much different relationship to gold and silver. I'm noting with great interest how China opened up its gold market, and people there do tend
well,
to...
there they've got a savings rate of some incredible level of, I don't know, 30 or 40% or something.
It is incredible. So that story of Asian love of gold is a very different thing. It's entrenched, it's cultural, it still makes sense. But in the U.S., somehow gold got dislodged and it's never gotten back into the main portfolio. So it's big news when some big pension fund, like there was a Texas fund that said, oh, we're gonna invest in gold, and they put $1 billion in. It was on the front of the Wall Street Journal, and that was still, I think, about 0.8% of that pension's assets. So it was a nominal sort of a toe in the water. When if you construct a portfolio that's completely blind and you go back through time and you say, what was the correct weighting to give you the best possible returns from 1900 to current, you want to have a really long view. That portfolio has a weighting of about 20% to gold, and it's extraordinary what the returns are. It's very easy to model, it's very easy to look at, and still we have such a severe underweighting in gold as an asset. At the institutional level, private investors, I'm seeing a lot more interest, obviously, today than we saw even 5 years ago or 2 years ago. 10 years ago, it was crazy talk, but now more and more people are getting into that sort of mentality. And part of my experience has been, I run into people all the time who say this same thing. They say, Chris, I read all your stuff, and I went and I talked with my broker about gold, and first they laughed, and then they said, you really shouldn't do that. Gold's in a bubble. Without really explaining how they came to that conclusion, and then would try and steer them into gold mining shares maybe, or some product that they could get their heads around. But physical bullion was not really on anybody's radar screen. Very, very small number of financial managers will even approach that topic. And it's important to understand that for the most part that represents a conflict of interest, because the portfolio manager or the financial manager, they do not get compensated if you hold physical bullion. They will get compensated if you buy GLD because it remains in your portfolio and they take a % of assets, or if you get, There are a variety of things they will recommend. It's surprising how many people still to this day don't understand that Wall Street has a very different set of interests from your own. Sometimes they align, and that's a happy coincidence, right? But when circumstances depart, you find out what's really going on. And this is where it's still surprising to me how many people fight their brokers without really understanding that there's a game being played here, and it has nothing to do with your financial security.
That's a very interesting point, because I think it was Adam Smith who was the first person who really got the idea across that both the buyer and the seller of a product can do a deal and be happy, both of them happy for their different reasons. This doesn't seem to apply to Wall Street, does it?
No.
Because there's such a conflict of interest in everything. They're no longer providing a service, I think. Anyway, I would love to continue for hours, because I've found this conversation absolutely fascinating, Chris, and thank you very much indeed for coming along and agreeing to take part in this interview.
Thank you. The pleasure's been mine, Alasdair.
Thanks again.